afternoon, folks. Pleasure being here because it was exactly, I think, in this hotel 4 years ago, exactly in this hotel 4 years ago, that the PMS Bazaar team, I remember, I think Pallav was probably sitting standing over there. I think Danny was sitting somewhere here. 4 years ago, we announced that Marcellus had got a license. At that time, we had zero assets. We had, I think, two people. We had two desks in our office. We had one laptop, right? That was the sum and substance of Marcellus 4 years ago. So when Pallav and team were kind enough to invite us this year, I thought about what should we speak about. And I realized that the most interesting thing from the perspective of the Indian investor, I think the most interesting subject from the perspective of the Indian investor is why foreign investors are getting more interested in pumping serious money into India. And in a way, reflecting Marcellus's own modest rise. 4 years ago, we had zero assets. Obviously, we had zero foreign investors. Now that we manage a significant amount of money for foreign investors in the PMS construct, now that we manage a significant amount of money for foreign investors in the PMS construct, I thought I would share with you why foreign investors are getting interested. What are the discussions we are having with them? Because my suspicion is over the next 3-4 years, just in the way that domestic investors have been the big story and they've taken the market to where it is, I think the next 3-4 years, the FII comes back in force and volume. And if people, all of us in this room understand that, it will help us become smarter investors. I think as I was standing outside, several people were asking us why we continue buying Divi's Lab, right? Questions like that, why we continue buying Dr. Lal, why we continue buying Divi's Lab in spite of the share price correction. A lot of that will become evident as I explain to you what's happening and how the foreign investor sees us. So I think the first thing to realize, and it's a point that not only FIIs, many people in our country don't realize, over the last 10, 20, 30 years, we've been one of the best performing markets in the world in dollar terms. In dollar terms, we've been one of the best performing markets in the world. If you take, for example, 20 years ka return, look at the 20-year CAGR, we've done 14.2% dollar TSR, dollar total return, 20 saal ka data, second only to one other market, right? Consistently, we've been a high performing market. For some reason, I don't fully understand, a lot of people in India lose a lot of sleep on China. Right? A lot of mind space is taken by China. You can see China's performance numbers on this chart, on this table, nothing to write home about. And underlying fundamental corporate performance by China Inc. is even worse than the numbers here would suggest, right? So that's the past. Over the last 20 years, this has already been a superstar market. What does the future portend for our market, right? The simplest way to understand the way the FII is beginning to see India, and I say it's beginning, I'm not sure the journey has yet fully climaxed. The more enlightened, the more forward-thinking FIIs are beginning to see India in the way they saw America in its heyday. 1880 to 1930 was the heyday of American growth. The rise and fall of American growth, the rise was that 50-year sort of vertical rise to becoming an industrial superpower. What happened? What happened in those 50 years? Effectively, in 50 years, America got joined up, it got consolidated, it got networked, right? In 1880s, the railroads came. In 1900, the telegraph came. 1908, the first motor car, Model T Ford came. And by 1930, the American road network was ready. And as you joined the country up, every single American consumer brand that you associate America with today was born in those 50 years, right? So for example, if you take tomato ketchup, Americans were having tomato ketchup in 1870, but it was a local market, right? Informal market, much like the achar market in India today. The most efficient ketchup manufacturer was Heinz. They had superior cash flows. They took those cash flows and consolidated. They acquired, they bankrupted other players, and by 1930, Heinz was the dominant player, which is why we don't lose too much sleep, honestly, in Marcellus, with quarter to quarter, year to year. Our goal is to Heinzify. Our goal is to play the Heinz in sector after sector after sector, look for the most efficient player, sabse zyada cash flow, encourage that management to be aggressive, to acquire, to destroy competition, and consolidate, right? And that journey is what, in a way, the foreign investors beginning to understand. Another way to think about it, we spent a lot of time with the folks at The Economist through spring, and this summer, for the first time in a decade, I think, we had a very positive cover story from The Economist. They actually followed it up with another cover story, another story 2 weeks ago. What The Economist is saying, and The Economist historically has not been a fan of India. This is a very influential publication, historically not a fan of India. The Economist is now saying for the next several years to come, this will be the world's fastest growing large economy. For the next several years to come, this will be the world's fastest growing large economy. This year, it's an evident point. We're going to end the year in 6 weeks, calendar year. India will grow, I reckon, between 6 to 7% this year. No other large economy will even grow at half that rate this year. And I think this is the point of view that the FII is building up in their head. Now, why are gradually the FII is becoming convinced that this is India today is America 1880? Broadly speaking, 4 sets of changes are becoming increasingly evident. Let me do a quick summary and then we'll dive into this, and then we'll look at the investment implications of this. First is, in the last 10 years, we have built more roads, more airports, more broadband, more fiber optic, more freight corridors. We built far more stuff in the last 10 years than in the preceding 60 years put together. Right? You show anybody, whether it's a FII or a DII, you show them that you have doubled your highway network in 10 years, you've pentupled your airline network in 10 years, you've tripled your bank accounts in 10 years, and you've grown broadband 50x. Anybody with half a brain will say, boss, this is very interesting. Secondly, amongst the world's large economies, we're the only one which in the last 10 years has reformed direct and indirect taxes. Same decade. Result kya hai? The result is today we have tax revenues growing twice as fast as GDP growth. I don't know about you, I haven't lived in any country where tax revenue grows twice as fast as GDP growth. That has massive ramifications. A big part of what we are seeing in corporate earnings is this piece. Tax revenue bhag raha hai, black economy crushed, we benefit, you benefit, right? Third piece. A decade ago, the banking system was as sick as a parrot, right? It had been devastated. A lot of people across political lines put their careers on the line to give you and me today a banking system which has the highest capital adequacy ratio in the world, a banking system which has the lowest stressed asset ratio in Indian history, right? A lot of hard work across political lines. People have put their careers on the line so that you and I can get home loans today at 8.5%, when the US home loan rate is 7.5%, right? Breathtaking developments there. And the final piece, the piece which I have to admit is even difficult for us to comprehend, the blinding pace of change in the digital economy. Nandan Nilekani did all of us a massive favor by thinking through the India stack. What's happening on the India stack, what's happening on the digital economy is actually difficult for even people like us. We earn our living by comprehending change, but the change here is utterly non-linear. We'll discuss that as well a little bit, right? So let's go through this a little step by step. The easy aspect of the physical infrastructure build, the easy aspect is to say, हाँ सड़क double हो गया है 10 साल में, new airports, freight corridors, right? That's the easy aspect to understand. But just think through what this means from a corporate perspective. What does it mean for working capital cycles, right? This is an absolute game changer. So let's put it like this. A decade ago, not even decade, say even 6 years ago, even 5 years ago, a truck would take to go from, say, Coimbatore to, say, Ludhiana. Coimbatore to Ludhiana, 6 years ago, was a 10-day journey on the truck. Because at every state border, the truck would stop, right? State taxes pay karne ke liye. And therefore, whether you are investing in a company with great logistics, SAP, RFID, or you are investing in a useless company, it didn't matter. Both trucks took 10 days because they were stopping along the way. Any promoter who told you and me, I'm investing in fleet management, you would have thought, this ko mental problem hai, disturbed brain hai. Why is he interested in fleet management? Kya manage karoge fleet? Your trucks are getting stopped every state border, right? Cut to the current day. State border mein truck queues, anybody seen truck queues at state borders? Gone, right? The same truck now goes from Coimbatore to Ludhiana in 2, maximum 3 days, right? First off, obvious implication for working capital. Your working capital shrinks, right? Haath mein cash zyada. Smart companies, working capital shrinks. But even more interestingly, now the men and the boys separate. The woman and the girls separate. The company which does fleet optimization, fleet management, technology investment, SAP, RFID, pulls away from its competition. Right? It was like my playing cricket in my neighborhood cricket ground. My weaknesses were not being spotted. And now I'm playing cricket in the IPL. Within 2 balls, I'll be exposed, right? So there are many facets of change in India which are like this. This is the most obvious one. The infrastructure piece is becoming so efficient that if you're not on top of your game as a promoter on infrastructure, you're getting left behind on cash flows and working capital, right? A corollary of that is the broadband piece, right? So 2016, broadband basically became free. You can see in the chart on the bottom left, data takes off. Data takes off, right? Look at the chart on the bottom left. Data absolutely roars through. If you therefore are a company which doesn't know how to harness data, analyze data, and make money from data, then God will have to save you. Because now we generate more mobile data. India generates more mobile data than either Europe or America. And this is with 45% smartphone penetration, right? As the data piece ramps up further, companies whose analytical capabilities are superior will pull away. Now, let's link it through with the tax piece. September 2019, everybody knows what happened, no? September 2019, FMG cut the corporate tax rate from 35 to 25. And what do we now see? If you see the chart on the bottom left, corporate tax collections or direct tax collections to GDP at an all-time high. Now, I've studied fiscal policy in college, but I never ever was taught that you cut the tax rate, you cut the corporate tax rate from 35 to 25, your collections actually go up. Why has that happened? It's happened because of GST. The way GST is constructed is actually very clever, right? So if you take our example, we pay GST as Marcellus, but we are told by the government that if we report our suppliers, we get a credit, right? And net, therefore, we don't actually pay anything because we net off. But every company gets that incentive that report your suppliers, you get a rebate, you get relief. And as a result, what's happening is cascading through the economy. Everybody is reporting their suppliers, which is why every month when you read in the newspapers, GST collection बढ़ रहा है, that's the cascade falling through. But when the government spots that the company has to be paying GST, you can be sure as night follows day, they tell the promoter, अब TDS भरो payroll पे, pay tax on PBT, and pay income tax as an individual. So you grab the company on GST collection to बढ़ ही रहा है. Look at indirect taxes, the dashed line, bottom left. But that is a lever by which the government is catching hold of the fellow and saying now pay direct taxes as well. So you have a situation where total tax take is growing at 25%, whereas GDP is growing at 11-12, nominal GDP growing at 11-12. What does that mean? That means you're squeezing the black economy. You're almost like, think of an orange in your hand and you're squeezing it. As you squeeze the black economy, official data from Ministry of Corporate Affairs क्या दिखा रहा है? That every year, for the last 5 years, every year, 8 lakh companies are shutting down. Official data. If 8 lakh is official, you can be sure as night follows day, unofficial number will be double that. Now, as those companies shut down, that market share goes to the companies we invest in, no? So when you see an Asian Paints doing volume growth of 12, an Astral Poly doing a revenue growth of mid-teens and volume growth of 11-12, it doesn't mean that the paints or the pipes sector is growing at that rate. It means that because the informal paints player and the informal pipes pair is being crushed, you're getting market share transfer. Black say white, and we've tried to sort of give you an example of the pipes sector, where 10 saal pehle it was half black, half white. We have now reached 2/3 white, 1/3 black. A decade hence, I suspect it'll be 4/5 white, 1/3, 1/5 black, right? But this story is not going to stop. India's tax to GDP is at 12%, all-time high, 12%. Southeast Asia is at 15%. As we go from 12 to 15, many lakhs of SMEs will get wiped out. Market share transference hoga, right? This has another ramification I'll come to in a minute. Let's do the banking system. Effectively from 2005 to 2014, 2005 to 14, India dispensed best part of $800 billion of power and infra loans. And as everybody knows, half that money went missing. The banking sector basically froze. Now, in June 2015, Raghuram Rajan ji called the bank CMDs. The CMDs of various banks were called to Mint Road. And the RBI governor, in what's called AQR, but in simple English, the RBI governor gave the bank chiefs 90 days to report real numbers, not the fake numbers. The banks were reporting fake numbers because effectively they were bust. Why were they bust? Because they had $400 billion of crap on their balance sheet. So the RBI governor said, I give you 90 days, publish real numbers, otherwise I'm going to take action. September 2015, we got real numbers from the banking system. The rot started emerging. But as you would expect, a certain class of promoter tried to lobby and put pressure on the RBI governor, basically to get him removed. The government didn't acquiesce. The government did not acquiesce. Instead, in 2016, the government expedited the Insolvency and Bankruptcy Act. Bharat Sarkar said, if you are an NPA, if the bank declares you an NPA, you get 90 days to get your act together. On the 91st day, we'll throw you onto the street. That was remarkable. Even then, people like me said, nahi, kuch nahi hoga. Promoter class will fight back. And what did we see? 2017, 2018, some of the biggest scoundrels in Indian history lost control of their companies. They now live in, either they're in London or they're in Tihar jail, right? Sort of two directions to go in, right? And those companies changed hands, right? So that was a salutary step. For the first time, our banking system was able to hold responsible the people who loot the banking system. But that wasn't enough. You can't just say, I have punished the wrongdoer. There was a big hole in the banking system to be plugged. If you have wiped out $400 billion of equity, you've got to put the money back in, no? So between the stock market, between all of us and the government, they plugged the hole in the banking system. Result is the charts on the right, stressed assets at a 15-year low, and bottom right chart, capital adequacy, shareholders' equity divided by loans outstanding, 17%, the highest amongst the world's large economies. The banking system is like the heart. What the heart does for our body, the banking system does for the economy. You clog up the heart, you know what happens? You clog up the banking system, which is where we were 7 years ago. We knew what happened. Some of you outside are asking me, hone kya wala hai? My point is, if you have a healthy banking system, you have corporate confidence high, we are bound to see a healthy outcome for the economy. Credit offtake is at 17. I reckon that will keep pumping up. As I said, home loan rates in our country are now comparable to US home loan rates. I didn't think I would see that in my career. And the last piece, the non-linear piece, right? This piece is the part where there's actually lots of value add to be done by everybody. The more you and I can figure this piece out, the more money we will make in India. So I'll take it step by step. I'll tell you whatever little we can understand, but there's plenty more work to be done. 2009, everybody knows Nandan Nilekani stepped down as CEO of Infosys, and he went to government and implemented Aadhaar. We all did our fingerprint, we did our biometrics. 1.2 billion Aadhaar IDs in 2009-10, right? But I don't think I fully realized why that was such a big deal. Real time, I didn't. 2014 May, Modi ji comes to power. A lot of people say Aadhaar to hat jayega. But you don't get to that level of political achievement without a super brain. I reckon the two men spoke, because what we heard next in late 2014 was Jan Dhan. PM said every person should have a bank account. And again, a lot of people said, "Ye to bakwas hai, nahi hone wala." But by 2015, it was done. 2015, 1.2 billion bank accounts, 1.2 billion Aadhaar IDs joined up. Even then, it didn't strike us why this is such a big deal. 2016, 𝐔𝐬 happened, right? 𝐔𝐬 happened. I showed you what the result of 𝐔𝐬 is, right? The result of 𝐔𝐬 is the bottom left chart, absolutely exponential blast in data, right? Now, Nandan Nilekani obviously is a better digital brain than 99% of us. NPCI, I reckon at his behest, said, let's now do UPI. 2016, UPI was launched, right? 𝐔𝐬 platform, Aadhaar and Jan Dhan joined up. Till a year ago, UPI was doing $500 billion of financial transactions in a year. Today, UPI is doing $1.3 trillion of of financial transactions. This is real-time payment settlement. This is the world's largest, by far the world's largest real-time payment settlement. 40%, 42% of Indian GDP, 42% of Indian GDP is going through UPI. If you add up with that IMPS, nearly 45% of GDP is now going through electronically. Paper-based payment is becoming less and less relevant. This is a massive game changer, right? First game changer, roughly 20% of SMEs now operate only on UPI. So your whiteification हो रहा है, आपका economy का whiteification हो रहा है. Small businesses who you historically had to chase कि बॉस tax भरो, the small business is voluntarily going digital. Tax take बढ़ रहा है. Second layer, पैसा बनाने का आपके मेरे लिए मौका. Let's take an example. Our office in Andheri East, there's a chai wala, young lad from Andhra who sells chai coffee outside. He does roughly 4,000 cups of chai coffee a day at 25 rupees a cup. A year ago, he stopped taking cash. Ordinary sadak ka chai wala hai. So I asked him, band kyun kar diya chai paisa lena? He said, dekho, you're going to give me 50 rupiya, I'm going to give you 25 back, time waste hoga. It takes me almost as much time to give you chiller as to make the coffee. Secondly, itna sara cash leke I have to go to the bank. I have to shut my tea stall for that, lost business. Instead, QR code, aap chai lo, QR code karo, I trust you to be an honest guy. QR code karo, and he's put a microphone so that he can hear in his ear that you have paid, right? Now step back and think what this means. Say, take for example, he's banking with HDFC Bank, just to take an example. HDFC Bank can now see that the chai wala outside our building is getting 4,000 credits every day of 25 rupees. Now you don't have to be a credit scoring genius to figure out, agar ye chai wala 4,000 baar isko 25 rupees mil raha hai, he should be given working capital finance. So whole new ecosystem opens up for banks to do WC finance. Second step, let's be even more proactive. What are the banks going to do next? The banks are going to reach out to their SME borrowers and say, I want to see all your business on UPI. I want to have visibility on all your business, and if you give me that, I'm going to give you a lower rate. So from a credit scoring, credit quality perspective, the game changes as well. We discussed so far that the banking system has surplus capital. We didn't discuss how will you use the capital. This is the most obvious use of capital. For the most needy section of corporate India, SMEs, their cost of capital is going to get transformed because they become part of the white economy in a way they never were, right? There are many other use cases of UPI. ONDC is one of them, but in the interest of time, let me stop there. It also helps that the entire Sarkar ka benefits ecosystem, the social security ecosystem goes through UPI. That's $70–80 billion of social security payments through UPI, right? Now, how does it all come together, right? These four changes are not working in isolation. It's an interlinked play. So start with the tax reforms. The more the government dabaos the SME, the more people will save through financial assets. Why did people buy flats and gold? Because black tha. 95% of Indian savings is flats and gold, not because they're great asset classes, because that was the only place to park black money. If you're going to go white, and you'll have to go white, nahi to Dubai bhago. If you're going to go white, you will financialize. If you financialize, people like us in this room are going to see more and more flows. PMS Bazaar's following will increase. Whoever out there, you're managing money, you're selling your products, your business is going to grow. But as you financialize, as you pump in, at the moment we're doing $300 billion a year of financial flows a year. We're a poor country. We're doing $300 billion a year of household financial savings every year. That's triple the rate of 10 years ago. It is mind-blowing the numbers that India is producing today. If you do that, the cost of capital goes down, right? There are many different metrics of financialization. I'm not going to go into it. You guys will know the metrics. But the more you financialize, the more you push the cost of capital down. But as you push the cost of capital down, who benefits more? The chota jeweler in Zaveri Bazaar or Titan, right? Chota jeweler benefits more, folks, or Titan benefits more from cost of capital going down like that? Titan, no. Titan borrows in the Bombay money market, and Titan borrows at lower and lower cost of capital in the Bombay money market. As you push the cost of capital down, who benefits more? The local path lab near my house in Powai, or Dr. Lal Path Lab, right? The local money lender in Satara, or Bajaj Finance. So what's happening as you financialize the economy, as your roads become better, your digital becomes stronger, the stronger companies are getting stronger. And you're polarizing the economy spectacularly, right? How spectacularly? This spectacularly. The dashed blue line in the chart upar, the dashed blue line is the share of top 20 corporates in India in PAT. Dashed blue line is share of top 20 corporates in India in corporate PAT. We've gone from 20%, dash blue line dekhiye, we've gone from 20% in FY10 to 70% in FY22. Now, does that affect the stock market? Does that affect how you and I invest? Absolutely it does. How does it affect you and I invest? It means that standard theories of efficient market hypothesis, CAPM, SHAPM, we can leave them with whoever writes books on academia mein. Why can we leave that? So see that chart on the top. Let me just give you a quick sort of tour of the chart on the top there. So if you see the December 12 wala point, 2012 wala point, what does the 70% mean? What we have tried to show you is, in a 10-year cycle, so the decade ending 2012, in the decade ending 2012, 70% of the Sensex constituents outperformed the Sensex, right? So how to read the chart is, every data point on the chart is, in a 10-year cycle, what proportion of the benchmark constituents beat the benchmark, right? And as you can see, till 2012, till the 10-year cycle ending 2012, this number was pretty steady. 60-70% of benchmark constituents would beat the benchmark. And that's actually a pretty efficient market. You've got a benchmark, India's best companies, the Sensex. In a 10-year cycle, 60 to 70% companies were beating the benchmark, right? And you can see that was pretty steady, 2004 through to 2012, lots of 10-year cycles, but 60-70% company benchmark ko beat kar rahe the, right? And then you can see what happens in the last 10 years, right? You polarize the market more and more and more as the strong get stronger. The latest read you can see far left pe, this 10-year cycle ending 2022, roughly a quarter of the Sensex participants are beating the market. Wealth creation in India is becoming an elite opportunity only to be pursued by the strongest of companies. If you don't have high-class management, high-class technology, lean manufacturing constructs, it's going to be harder and harder to deliver wealth over long periods of time. You can still do it. The whole game of sasta kharido, mehenga becho, for people who have that talent, is still doable. But the fundamental story about the country now is consolidation of the economy. The strong get stronger in every sector, right? Now, what does it mean for us? What does it mean for investors in this audience, right? So one simple way to do this systematically is take data for 20 years. Every year when the year ends, calculate on a backward-looking basis who the best companies were, A, on ROCE, and B, on reinvestment. Reinvestment kyun? Because reinvestment is a measurement of growth potential. So every year, if you waited till the year end, identified the companies who were above average on ROCE and above average on reinvestment, roughly 20 companies would make the cut. You can then create 20 portfolios for the last 20 years. If you crunch the data, what you see is very interesting. These companies are compounding at around, the stack on the far right, folks, the stack on the far right, these companies, the best companies, best on ROCE and reinvestment, are compounding share prices at around 17%. Interestingly, CCP long-term CAGR, 4-year CAGR is around 18%, right? So this is similar to our portfolio. You're compounding your share prices around 17-18%, but your free cash flows are compounding at 22%, right? Why is that happening? Because the market is not yet clocking the way the country is polarizing. So that 17 versus 22, the way we see it is, that is the free lunch. That is the free lunch Indian equities is offering all of us, and that's the free lunch the foreign investor wants to come and eat, right? The foreign investor wants to capitalize on the changing face of India. The foreign investor wants to capitalize on the Indian century, and hence the foreign investor, we think, will come to India in large numbers. Thanks to PMS Bazaar and thanks to SEBI's PMS construct, all of us and this country will benefit as foreign investors swing their $3.5 trillion from China I'm not saying they're going to swing the entire 3.5 trillion to India. हमारा country का market cap ही 3.5 trillion है. So please don't quote me as saying Saurabh ने बोला साढ़े तीन trillion आएगा. Even if the foreign investor swings 3.5 trillion का आधा trillion to India, that doubles the FII participation. So thank you very much, folks. Thank you for listening to me. Best of luck to PMS Bazaar and their clients. Thanks a lot.